Welcome to Petros Family Wealth. Today we're going to cover a SharkFin Structured Note, which is a bearish call where you're anticipating that the stock market's going to be coming down and how you might be able to benefit from it by using this strategy. This one's going to be a little bit more in the weeds, and you're going to be able to get a little more detail of how this would work and some examples. But if you haven't checked out or you're not sure what a structured note is, go ahead and check out our other videos first. They're a little more boring, a little more basic. Get the definitions down, and then come back here and check this one out. And just for those that are new to Petros, we provide handcrafted investment strategies for the families that we work with in order to help them achieve their goals. And this is purely an educational video. It's not a recommendation for you and your family. This is here to arm you, educate you, and try to add an arrow to your quiver when navigating the markets. With that in mind, let's go ahead and dive in. Now, the shark fin, that is a nickname based on essentially the payoff amount if you're designing or going through a couple of different scenarios. But the technical term of this is considered a auto-callable, capped, dual directional note. And this one is a hypothetical, it's linked to the S&P 500. That's why we call it SharkFin. It's a heck of a lot easier to see. But what we're going to do, we're going to start off describing that this one is a principal protected note. So this one is principal protected based on the full faith and credit of the issuer. So let's say we have this SharkFin with Goldman Sachs or JP Morgan or Morgan Stanley or whoever else. It's principal protected as long as those companies are able to pay their debts. So it does have credit risk similar to a traditional corporate bond. However, unlike a regular corporate bond, instead of paying us interest, we're going to tell them to say, hey, hold off on paying us that interest. And we want you to put some protections or some downside or some hedges here to provide us a potential outcome that'd be favorable to us. So again, this one's a bearish note. And so the way this one works is, this is an example, 13 months. And let's start off with if the stock market just keeps rip-roaring, keeps going upwards. We're also going to cover, hey, what if the market travels downwards throughout the course of that 13 months? And then let's say we have a waterfall or a moment here where the market just crashes, what that would look like as well. So for that first example, let's say you buy this and during that 13 months, the market just kind of creeps upward and the stock market is up, let's say 10%. You potentially, in this hypothetical, you would get paid about 5.15%. And so typically when we design these, we want to try to be comparable to other fixed income assets, maybe taking some risk off the table, taking some exposure off of our equities, and buying something like this. And if the market continues to do well, at least you got paid something in the meantime. But where this starts to really shine is in that bearish side, so where the market's coming down. And so that's where we have that dual directional, or it's like an absolute return. So let's say you buy this and the market's creeping downward, bounce coming up, coming down, and at the end of that 13-month, let's say the market's down 13%. Well, in this case, you get one-for-one upside, meaning, so in this case, if the market is down 13%, well, you would be positive 13%. It's that absolute return. You get that absolute return all the way up to negative 20. And so if the market is down 5, you're up 5. If the market is down 10, you're up 10. And that's when you can see that bearish play start to come in handy if you anticipate that market being down. Well, at least a portion or a sliver of your portfolio is potentially positive with this type of structure. But now let's go over that third scenario. And this one's probably potentially the most helpful, particularly for folks that are usually more growth-minded but maybe nervous about the market. What happens if we have a huge waterfall downturn and you buy this and then 2 months later or sometime during that 13-month period, let's say the market's down 20% from when you purchase this. What happens, there's a daily observation where if the market's down 20 from when you purchased it, well, you get all your cash back within 2-3 days. And what that allows you to do is if the market's down 20, perfect, you get cashed out. Now you have cash ready to go to maybe reinvest in a growth-oriented note or your traditional equity portfolio, whether ETFs, some sort of stock allocation there. And that gives you the ammunition to lean into that weakness in order to hopefully grow out of that rough spot. So again, market keeps rocking and rolling. Well, you're capped at that 5% return. So let's just say the market's up positive 10, you make 5. If the market's down 13, well then you have that positive 13 during that 13-month period. And then if the market's down, let's say 25 or starts to hit that, well, you didn't make any money, but also now you got cash ready to deploy back into your strategic allocation. So I hope you enjoyed that. Hope it's helpful to kind of understand what that might look like and how that might interact with the rest of the portfolio. And if you have any questions or if you want to incorporate this into your portfolio, give us a holler, and I'd love to share how we can help folks with their investment strategies. Hope you enjoyed, and if you did, go ahead, like, subscribe, and hit that notification button. Thank you.